There is a ghost that haunts the portfolios of 99% of investors. It's a seductive whisper, a siren song of impossible recovery that leads countless fortunes onto the rocks. It's the promise of the turnaround. The idea that a broken, bleeding, forgotten company is just one brilliant CEO, one revolutionary product, one lucky breakaway from a glorious resurrection. We see a stock that has fallen 90% and our mind doesn't register the catastrophic failure. It sees a lottery ticket. If it just goes back to where it was, we think, we'll make 10 times our money. This is the single most destructive myth in the world of personal finance. A high-risk gamble disguised as a sophisticated strategy. It's the fast track to the poorhouse, paved with the cobblestones of hope and delusion. But there is another way. A path forged not in the desperate hope for miracles, but in the calm, rational assessment of durable excellence. It's the path walked by Warren Buffett, a strategy that has built one of the greatest fortunes in human history. And at its core is a simple, powerful, and transformative principle. Turnarounds seldom turn. It is infinitely more profitable and profoundly safer to invest in a wonderful business that has stumbled into a temporary problem than it is to invest in a terrible business that needs a series of miracles just to survive. This isn't just a folksy saying from Omaha, it is a razor-sharp mental model that separates the amateur from the professional, the gambler from the investor. It prevents the catastrophic error of wasting precious time and irreplaceable capital trying to catch the falling knife of a failing enterprise. By the time we are done here, you will possess a new lens through which to view the entire stock market. You will learn to surgically dissect a company's prospects, to distinguish between a surface wound on a titan and a terminal illness in a corporate zombie. This is the financial transformation that awaits you. You will stop chasing ghosts and start acquiring pieces of wonderful, resilient businesses. You will learn that the highest probability path to financial freedom is not found in the intensive care unit of the stock market, but in the executive suites of companies built to last for a century. This is the final promise of quality investing. To truly understand this profound shift in thinking, we must first build our foundation. We must learn to see the world through Buffett's eyes, and that means starting not with price, but with quality. The first and most crucial pillar of this entire philosophy is mastering the anatomy of a wonderful business. Before you can even begin to diagnose a temporary problem, you must be an expert at identifying permanent strength. This is the great filter that eliminates 95% of the companies trading on the market from your consideration, saving you from a world of future pain. It's a lesson Buffett himself had to learn, a transition from a purely quantitative approach to a qualitative one, and the story of that transformation begins with a box of chocolates. In the early days, Warren Buffett was a disciple of his mentor, Benjamin Graham. He was a practitioner of what he would later call cigar butt investing. The idea was simple and brutally quantitative. You walk down the street and you find a cigar butt on the ground with one good puff left in it. You pick it up, take that final puff for free, and toss it away. In investment terms, this meant finding companies that were statistically, almost absurdly cheap. Companies trading for less than the cash they had in the bank, or for a fraction of their working capital. The quality of the business itself was almost an afterthought. If you could buy a dollar for 50 cents, you did it, regardless of whether that dollar was part of a thriving enterprise or a dying textile mill. And for a time, this worked, but it was laborious, the gains were finite, and it was not scalable. You could never put billions of dollars to work buying these tiny discarded cigar butts. The profound shift in his thinking, the one that would unlock astronomical wealth, came in 1972. It came from his partner, Charlie Munger, and it came in the form of a California-based candy company called See's Candies. See's was a beloved West Coast institution, founded by Mary See in 1921. It was a family-owned business with a fanatical customer base, known for its high-quality chocolates and old-fashioned service. When it came up for sale, Buffett took a look. The numbers were good, but not cigar butt cheap. The family wanted $30 million for the business. Buffett, using his strict Graham-inspired calculations, figured the tangible assets, The buildings, the equipment, the inventory were only worth about $8 million. The remaining $22 million was for something intangible, something called goodwill. For the old Buffett, paying a massive premium over book value was heresy. His analysis showed the company was worth at most $25 million. He was ready to walk away. But this is where Charlie Munger stepped in and changed the course of investment history. Munger argued that they were thinking about it all wrong. See's Candies wasn't just a collection of tangible assets. It was a fortress. It had a brand that was deeply embedded in the minds of its customers. People didn't just buy See's for a chocolate fix. They bought it for Christmas, for Valentine's Day, for birthdays. It was part of family traditions. This brand loyalty gave See's pricing power. They could raise their prices year after year to account for inflation, and their customers wouldn't even think of switching to a cheaper brand. This, Munger explained, was a durable competitive advantage, an economic moat that protected the business from competition. This intangible asset, this goodwill, was far more valuable than any factory or storefront. Buffett, to his immense credit, listened. He was intellectually flexible enough to realize the limitations of his old model. They negotiated and bought See's for $25 million. That single decision became the bedrock of the modern Berkshire Hathaway philosophy. Over the subsequent decades, See's Candies would generate more than $2 billion in pre-tax earnings for Berkshire, all while requiring very little additional capital investment. It was a cash-generating machine. It taught Buffett that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. See's became his template for identifying quality, the living proof that the most valuable asset a company has doesn't always show up on the balance sheet. It forced him to evolve from a mere statistician of cheapness to a connoisseur of business excellence. The psychological principle at play here, the one that traps most investors in a cycle of mediocrity, is a powerful cognitive bias known as the focusing illusion, combined with an aversion to complexity. When we look at a stock, the easiest, most readily available piece of information is its price. The stock is $10. Last year it was $20. It feels cheap. Our brain latches onto this simple, quantifiable number. This is the focusing illusion. We give disproportionate weight to this one piece of information. The harder, more complex task is to assess the qualitative aspects of the business. What is its competitive position? How strong is its brand? Is the management team honest and competent? Answering these questions requires deep thought, research, and judgment. It's hard work. So our brains, which are inherently lazy and designed to conserve energy, default to the easy number, the price. We become bargain hunters, not business analysts. This is the psychological trap of cheapness. We feel smart for buying something at a low price-to-earnings ratio or a low price-to-book value, but we fail to ask the most important question: why is it cheap? Often the answer is because the business is terrible, it's a melting ice cube, and the market has correctly priced it for its eventual demise. Buffett's breakthrough, prompted by Munger and proven by See's Candies, was to consciously override this cognitive shortcut. He forced himself to invert the process. He would not ask, "Is this stock cheap?" He would first ask, "Is this a wonderful business?" Only after the answer to that question was a resounding yes would he even begin to consider the price. This inversion is a superpower. It protects you from the siren song of value traps and focuses your finite energy on the small universe of companies that are actually worth owning for the long term. It's a deliberate choice to engage with complexity, to do the hard work of qualitative analysis, because that is where the true durable profits are found. So how can you, as an investor aiming for financial freedom, replicate this process? You need an applied mental model, a blueprint for identifying these wonderful businesses. Let's call it the Quality Investor's Checklist. It's a 4-step framework for performing your own stock analysis, designed to instill the CEO mindset required for successful long-term investing. Step 1 is to identify the economic moat. A moat is a sustainable competitive advantage that protects a business from competitors, allowing it to earn high returns on capital for many years. There are four main types. First, brand. Think of Coca-Cola or Apple. Their brands are so powerful they create customer loyalty and pricing power. Second, a patent or regulatory advantage, like a pharmaceutical company with a blockbuster drug. Third, high switching costs. Once your business is running on Microsoft Windows and Office, the cost and disruption of switching to another ecosystem are immense. And fourth, a low-cost advantage, like Costco or Geico, who can operate more efficiently than rivals and pass savings on to customers. Your first task is to be able to clearly articulate, in a simple sentence, what a company's moat is. If you can't, it probably doesn't have one. Step 2 of the blueprint is to assess the quality of the management. Buffett says he looks for three things in a manager: integrity, intelligence, and energy. And if they don't have the first, the other two will kill you. To assess this, you must become a student of leadership. Read the annual shareholder letters going back at least a decade. Does the CEO speak with candor about both successes and failures? Or is the letter filled with corporate jargon and blame shifting? Look at their track record of capital allocation. Do they reinvest profits wisely in projects that earn high returns, or do they squander cash on overpriced ego-driven acquisitions? Do they buy back stock when it's cheap or when it's expensive? A great manager thinks like an owner, and their primary job is the intelligent allocation of your capital. Step 3 is to analyze the company's financial strength. A wonderful business is not a speculative venture. It is a proven winner. You are looking for a long-term track record of consistent and growing profitability. Key metrics to look for are a high return on equity, ROE, and return on invested capital, ROIC, generally above 15% for many years. This shows the business is efficient at generating profits from its assets. You also want to see a strong balance sheet with very little debt. Debt is a magnifying glass. It makes good times better, but bad times fatal. A wonderful business doesn't need to rely on leverage to generate strong returns. Finally, step 4 is to operate within your circle of competence. This is perhaps the most crucial rule. You must invest only in businesses that you genuinely understand. You don't need to be an expert in everything. You just need to know the boundaries of your own knowledge. If you can't explain how the business makes money, what its competitive landscape looks like, and what the key drivers of its future success are, then you should not own it. Period. Following this 4-step checklist, moat, management, financials, and competence is the foundation of quality investing. It forces you to think like a business owner, not a stock market gambler, and it is the only reliable way to build a resilient portfolio capable of beating the S&P 500 over the long run. Now let's explore the antithesis, the path walked by the 99% of investors who fail to grasp this principle. They get caught in what we can call the cigar butt trap. This is the world of buying statistically cheap but fundamentally flawed businesses. Ironically, the best example of this is Warren Buffett's own investment in the company that would make him famous, Berkshire Hathaway. In the early 1960s, Berkshire Hathaway was a struggling textile manufacturer in New England. The entire American textile industry was in a slow, painful decline due to rising competition from low-wage countries. It was a terrible business. It required constant capital expenditures just to stay competitive, yet it earned pathetic returns. But it was cheap. The stock was trading for so little that it was worth more dead than alive. So, Buffett started buying the stock. His plan was to make a quick, unspectacular profit as the company slowly liquidated itself. However, a dispute with the then CEO, Seabury Stanton, led Buffett to buy a controlling interest in the company out of spite. He was now the captain of a sinking ship. He spent the next 20 years trying to keep that terrible textile business afloat. He poured the profits from his other, better investments into modernizing the mills, but it was like trying to fill a bottomless pit. The industry economics were just too brutal. He later admitted that this was a monumental mistake. While he did eventually use Berkshire Hathaway as a holding company to buy other wonderful businesses, the original textile operation was an anchor that dragged down his returns for 2 decades. He learned the hard way that a fair business at a wonderful price is a recipe for frustration and mediocre results. The 99% of investors are still stuck in this trap. They screen for stocks with low PE ratios. They see a company in a dying industry trading below its book value and think they've found a bargain. They fail to understand that book value in a bad business is often a mirage. Those assets can't be liquidated for anywhere near their stated value. They end up, like the young Buffett, captains of sinking ships, wondering why their portfolio growth has stalled. The direct financial connection here is the profound difference between a one-time gain and a compounding machine. A cigar butt investment, if it works at all, gives you one puff. You buy a mediocre company for 50 cents on the dollar. Maybe it liquidates or gets bought out, and you get your dollar. You've doubled your money. It feels good. But then what? The game is over. You have to go find another cigar butt. It's a grueling, transaction-heavy process. A wonderful business, on the other hand, is the gift that keeps on giving. Let's look at the numbers behind See's Candies. When Buffett bought it for $25 million, it was earning about $2 million after tax. Today, it generates over $100 million a year in profit. The key is that it achieved this growth without requiring much additional capital. The profits it generated were a gusher of cash that Buffett could then use to buy other wonderful businesses. The financial metric that captures this magic is return on invested capital, or ROIC. A terrible business, like a textile mill, might have $100 million in assets and earn only $5 million in profit, a 5% ROIC. To grow, it has to constantly buy new, expensive machinery. A wonderful business like See's can earn $50 million in profit on just $50 million of invested capital, a 100% ROIC. It doesn't need new capital. It produces it. This free cash flow is the engine of compounding. A portfolio filled with high ROIC businesses is a portfolio that grows almost on its own. The capital gains are not a one-time event. They are the result of a multi-decade process of value creation. This is the ultimate goal of any serious wealth management strategy. It's not about finding a lucky stock pick. It's about acquiring a collection of compounding machines. And that process begins and ends with an uncompromising focus on quality. Once you have mastered the art of identifying a wonderful business, you are ready for the second pillar of Buffett's strategy, applying the temporary problem litmus test. This is where opportunity meets preparation. The market, in its infinite wisdom, will occasionally offer you one of these jewels of the corporate world at a fair or even a cheap price. This rarely happens when the sun is shining and the news is good. It happens when the company stumbles. It happens when there's a scandal, a product recall, an earnings miss, or an industry-wide panic. The key is developing the analytical skill to separate a temporary stumble from a terminal fall. One is a golden buying opportunity. The other is a value trap that will destroy your capital. The ability to make this distinction is what separates the legendary investors from the crowd. For Buffett, the defining moment that crystallized this principle came early in his career, long before See's Candies, in what would become known as the Great Salad Oil Scandal. The year was 1963. The company was American Express. At the time, American Express was primarily known for two things: its traveler's checks and its charge card, both of which had dominant, fortress-like positions in their markets. But it also had a smaller, less glamorous division involved in warehousing. Essentially, companies could store their inventory in an American Express warehouse, and American Express would issue a receipt for that inventory. Other banks would then lend money to the company, using that receipt as collateral. It was a business built entirely on trust. The assumption was that an American Express receipt was as good as gold. That assumption was about to be shattered. A New Jersey-based company called the Allied Crude Vegetable Oil Refining Corporation was a major customer of the American Express warehousing division. Its owner, a man named Tino De Angelis, had devised a brilliant and audacious fraud. His massive storage tanks in Bayonne, New Jersey, were supposed to be filled with valuable salad oil. In reality, most of them were filled with seawater, with only a thin layer of oil floating on top for inspectors to see. He had created phantom inventory, received American Express receipts for it, and used those receipts to secure over $150 million in loans from dozens of banks. When the fraud was discovered, Allied Crude immediately went bankrupt. Wall Street panicked. The banks who had made the loans were facing catastrophic losses, and they turned to the one entity they thought could make them whole, American Express. The market's reaction was swift and brutal. The fear was that American Express would be on the hook for the entire $150 million in fraudulent loans, a sum that would wipe out the company's net worth. The stock collapsed, falling by nearly 50% in a matter of weeks. The narrative was set. American Express was facing bankruptcy. The brand, built on a century of trust, was thought to be shattered forever. This is where the 23-year-old Warren Buffett entered the picture. While the rest of the world was panicking, he was asking a simple question: has the underlying nature of the wonderful business changed? He knew the warehousing division was in trouble, but he also knew it was a tiny, non-essential part of the company. The real value, the economic moat, resided in the traveler's checks and the charge cards. So he got to work. He didn't just read analyst reports. He did his own on-the-ground research, what the legendary investor Peter Lynch would later call scuttlebutt. Buffett went to restaurants and travel agencies. He talked to cashiers and customers. He observed transactions. He asked them, "Have you stopped accepting the American Express card because of this salad oil scandal?" The answer was a universal no. Nobody connected the obscure warehousing fraud with the trusted green card in their wallet. He went to banks and asked if they had seen any decline in the sales of travelers' checks. Again, the answer was no. The competitive advantage, the brand loyalty, the moat around the core businesses was completely intact. The market was catastrophically wrong. It had mistaken a problem in a small, leaky boat for a hole in the hull of the battleship. Convinced of his analysis, Buffett acted decisively. He invested 40% of his investment partnership's assets, a massive, career-defining bet, into American Express stock. He was buying a wonderful business whose reputation was, in his assessment, only temporarily tarnished by a problem that was containable and ultimately irrelevant to its long-term earning power. His conviction was rewarded. As the legal situation became clearer, it turned out American Express's liability was far less than feared. The market realized its mistake, and the stock roared back. Within a few years, Buffett had made a fortune for his partners. The salad oil scandal became his foundational anecdote, the ultimate proof that a great company's temporary problem is the intelligent investor's greatest opportunity. The psychological principle that creates these opportunities is a potent combination of catastrophic thinking and the availability cascade. When a negative event occurs, especially a dramatic and well-publicized one like a major scandal, our brains engage in catastrophic thinking. We extrapolate the worst-case scenario and treat it as a certainty. The fear of loss is a much more powerful emotion than the prospect of gain, so we are wired to overreact to bad news. This initial overreaction is then amplified by the availability cascade. The media reports on the scandal. Financial news networks run specials on the company's impending doom. Online forums buzz with panicked sellers. The story is repeated so often and from so many sources that it becomes an available fact in our minds. We stop questioning the narrative because we hear it everywhere. It feels true, so we assume it is true. The stock price plummets, which serves as further social proof that the company is doomed, creating a vicious, self-reinforcing cycle of panic. Buffett's superpower is his emotional discipline. He is able to insulate himself from this cascade of fear. He doesn't allow the dramatic narrative to substitute for his own independent stock analysis. He calmly focuses on the second and third order questions. Does this problem affect the core reason customers use the product? Does it permanently impair the company's long-term earning power? By focusing on the business fundamentals rather than the terrifying headlines, he can see the reality that the panicked crowd misses. He exploits the market's emotional short-term reaction for his own rational long-term gain. To apply this principle yourself, you need a mental model for sorting through corporate problems. Let's create the problem-solving matrix. Imagine a simple four-quadrant box. The horizontal axis measures the source of the problem, ranging from internal to external. The vertical axis measures the impact of the problem, ranging from superficial to moat-damaging. Your goal as an investor is to find companies with problems that fall into the external and superficial quadrant. An internal problem is one caused by the company itself, for example, management fraud, a botched product launch, or an accounting scandal. An external problem is caused by forces outside the company's control, a recession, a rise in interest rates, or a panic in the broader market. A superficial problem is one that affects short-term earnings but doesn't harm the long-term competitive advantage. Think of a one-time factory fire or a temporary supply chain disruption. A moat-damaging problem is one that fundamentally weakens the company's competitive advantage. This could be a new technology that makes its product obsolete, or a data breach that permanently destroys customer trust. Let's place some examples in our matrix. The American Express salad oil scandal was an internal problem caused by their warehousing division's failures, but Buffett correctly diagnosed it as superficial because it did not damage the moat of the core card and check businesses. An even better opportunity is a company in the top right quadrant, an external and superficial problem. Imagine a wonderful company like Coca-Cola seeing its stock fall 30% simply because the entire market crashes due to a recession. The problem is external, the recession, and it is superficial to Coke's long-term business. People will still drink Coke. This is the absolute sweet spot for a quality investor. The bottom left quadrant, internal and moat damaging, is the danger zone. This is a company like Wells Fargo during its fake account scandal. The problem was internal, created by a toxic sales culture, and it was moat damaging. It eroded the trust that is the bedrock of a bank's brand. These are the companies to avoid at all costs. The bottom right quadrant, external and moat damaging, is a company facing a paradigm shift, like Kodak facing the rise of digital cameras. The problem was external, a new technology, and it was fatal to its moat. By using this problem-solving matrix, you can move beyond emotional reactions and develop a systematic, rational trading strategy for evaluating corporate crises. It provides a blueprint for finding undervalued stocks that are truly on sale, not just on their way to the graveyard. The antithesis of this disciplined approach is the path of the 99%, mistaking a terminal illness for a common cold. This is one of the most common ways retail investors destroy their wealth. They see a formerly great company whose stock has been decimated, and they anchor to its past glory. Their analysis is based on nostalgia, not on a cold-eyed assessment of the present reality. The classic example is Blockbuster Video. In the early 2000s, Blockbuster was a dominant force in home entertainment. Its brand was ubiquitous. But a new technology, DVD by mail, and then streaming video, emerged. This was a classic external, moat-damaging problem. The company's entire business model, built on physical stores and late fees, was becoming obsolete. Yet for years, investors bought the stock on its way down, thinking, Blockbuster is such a huge brand. It's a household name. They'll figure it out. They mistook the brand's past strength for a guarantee of future success. They were betting on a turnaround. They failed to see that the moat, the convenience of a local video store, had not just been damaged, it had been completely flooded and rendered irrelevant by a superior business model. They fell in love with a narrative of recovery, ignoring the brutal financial evidence that customers were leaving in droves for Netflix. Every dollar they invested in Blockbuster on its way to bankruptcy was a dollar that could have been invested in Netflix itself. This is the ultimate trap of turnaround investing. It's not just that you lose money. It's the colossal opportunity cost of what that money could have been doing in a thriving, forward-looking enterprise. This brings us to the direct financial connection, the all-important concept of the margin of safety. Benjamin Graham defined it as the cornerstone of investment. It means buying a security for significantly less than its underlying or intrinsic value. When you buy a wonderful business experiencing a temporary problem, the market's panic is what twice gives you that margin of safety. Let's quantify it. Suppose your stock analysis concludes that a great company has an intrinsic value of $100 per share. In normal times, it might trade at $90 or $95, but then a temporary superficial problem hits and the panicked market sells the stock down to $50. Your margin of safety is $50 per share, or 50%. This does two things. First, it provides downside protection. If you are wrong in your analysis and the company's value is actually only $80, you still have a $30 cushion. You are less likely to lose money. Second, it provides tremendous upside potential. If you are right, and the stock recovers to its intrinsic value of $100, you have doubled your money. The temporary problem allowed you to purchase future earnings power at a massive discount. Now contrast this with investing in a so-called turnaround. This is a company whose intrinsic value is actively declining. It might be trading at $10, down from $50. The investor thinks, it's cheap. But the problem is that its intrinsic value might only be $5 and heading to zero. There is no margin of safety here. You are not buying $1 for 50 cents. You are buying $1 for $2 because that dollar of assets is about to be worth nothing. Understanding this distinction is the key to capital preservation and long-term portfolio growth. The goal is not to buy what is cheap in price, but to buy what is cheap in relation to its true, durable value. And those opportunities are almost exclusively found when Mr. Market, in a fit of temporary insanity, offers you a wonderful business at a foolish price. This temporary insanity of Mr. Market is not a rare or random event. It is a predictable feature of human psychology, and understanding it is the third great pillar of the Buffett philosophy, mastering the psychology of the panicked crowd. It's not enough to be a good business analyst. You must also be a practical psychologist. You need to understand why the market, which is composed of millions of supposedly rational individuals, so often behaves like a manic-depressive lunatic. Buffett's famous allegory of Mr. Market describes him as your business partner. Some days he is euphoric and offers to buy your shares at ridiculously high prices. Other days he is despondent and offers to sell you his shares at absurdly low prices. Your job is to ignore his mood swings and transact with him only when it is to your advantage. And the greatest opportunities arise when he is in the depths of despair. A prime example of Buffett exploiting this despair occurred in the mid-1970s with his investment in the Washington Post. The timing could not have been worse. The nation was in the grip of a brutal recession and a bear market. The Washington Post Company, under the leadership of Katharine Graham, was at the center of the political firestorm that was the Watergate scandal. The Nixon administration was openly hostile to the newspaper, even threatening the broadcast licenses of its valuable television stations. On top of that, Wall Street was deeply skeptical of newspaper stocks in general, viewing them as old media dinosaurs. The combination of a bad economy, political risk, and industry pessimism was a toxic cocktail. The company's stock was obliterated, falling by more than half. The entire public market capitalization of the Washington Post Company, which included the newspaper, Newsweek magazine, and 4 major network-affiliated TV stations, sank to just $80 million. The crowd wanted nothing to do with it, but Warren Buffett, insulated in his Omaha office, saw a completely different picture. He wasn't looking at the stock chart or the scary headlines. He was analyzing the business. He saw that the Washington Post newspaper had a virtual monopoly in its market. It was the dominant source of news and advertising in the nation's capital, a formidable economic moat. He also understood the immense value of the television stations. In fact, his analysis showed that the TV stations alone were worth more than the entire $80 million price tag the market was placing on the whole company. In essence, Mr. Market was in such a state of panic that he was offering to sell Buffett 4 highly profitable TV stations, and as a free bonus, throw in one of the world's most prestigious newspapers and a national magazine. It was a classic case of a wonderful business, or rather, a collection of them, being offered at a foolish price due to a perfect storm of external, temporary problems. Buffett started buying aggressively. Over the next year, he invested nearly $11 million, acquiring more than 10% of the company. He had to be patient. The stock went nowhere for a few years. But he had conviction in his analysis of the underlying business value. Eventually, the recession ended, the political turmoil subsided, and the market came to its senses. The stock soared. That $11 million investment would eventually become worth over $1 billion, one of the greatest investments of his career. He achieved this not by predicting the economy or the political climate, but by calmly exploiting the irrational fear of the crowd. The psychological force behind this market behavior is one of the most powerful and primitive instincts we possess: herd behavior. As social creatures, we are wired for survival, and for millennia, survival meant staying with the tribe. Going against the group was dangerous. This instinct is deeply embedded in our brains. When we see everyone else selling, our brain screams, "Danger, flee!" It feels physically and emotionally wrong to do the opposite. This is compounded by the principle of social proof. We assume that if so many other people are doing something, they must know something we don't. So we follow along, outsourcing our own critical thinking to the anonymous, and often wrong, wisdom of the crowd. Buffett's true genius may not be his analytical ability, but his temperament. He has cultivated a mindset of radical independence. He genuinely does not care what other people are doing or thinking. As he famously said, "Be fearful when others are greedy, and greedy only when others are fearful." This is easy to say, but incredibly difficult to do. It requires overriding the powerful emotional signals coming from the amygdala, the brain's fear center, and relying instead on the cool, rational logic of the prefrontal cortex. He has trained himself, over a lifetime, to view market panic not as a threat, but as an opportunity. He sees the herd's fear as a pricing mechanism, a force that temporarily disconnects a stock's price from its underlying value, creating the very bargains he seeks. This CEO mindset, this ability to stand alone, is not an innate gift. It is a learned skill, and it is essential for any investor who wishes to achieve extraordinary results. How can you develop this contrarian muscle? You need an applied mental model for independent thought. Let's call it the Contrarian's Checklist. It's a 4-part discipline to help you break free from the herd. First, curate an anti-news diet. The daily fire hose of financial news is designed to provoke an emotional response. It thrives on hype and fear. Limit your exposure. Stop checking stock prices every day. Instead, focus your reading on long-form, in-depth sources, company annual reports, industry journals, and biographies of great business leaders. You want to be an expert on the business, not on the daily fluctuations of its stock price. Second, write down your investment thesis before you buy. Force yourself to articulate, on paper, in simple language, why you are buying this company and what you believe it is worth. This act of writing clarifies your thinking and creates a rational anchor. When the market panics later, you can revisit your written thesis and ask, has anything about my original, calm analysis of the business fundamentally changed? This protects you from being swayed by the emotions of the moment. Third, actively invert the popular narrative. If everyone is saying a company is doomed, make a steelman case for why they might be right. Argue against yourself. Try to poke holes in your own thesis. If your thesis survives this rigorous self-critique, your conviction will be 100 times stronger. This process of inversion is a powerful tool for developing true intellectual independence. Fourth, set your buying and selling prices in advance. When you are in a calm, analytical state of mind, Decide what price would represent a true bargain for a company you've researched. Write it down. Then, wait. If the market never offers you that price, you do nothing. If a panic hits and your price is triggered, you can act with confidence, knowing the decision was made with logic, not emotion. This checklist is a training regimen for your brain, building the mental fortitude required for successful, contrarian, long-term investing. The antithesis to this disciplined, contrarian approach is the path followed by the vast majority of market participants, chasing momentum and succumbing to FOMO, the fear of missing out. This is the psychological opposite of Buffett's strategy. Instead of buying when others are fearful, these investors buy precisely because others are greedy. They see a stock that has gone up 100% and feel an overwhelming urge to jump on the bandwagon. They are not driven by an analysis of the business's value, but by the fear of being left behind. The most dramatic example of this in modern history was the dot-com bubble of the late 1990s. Companies with no revenue, no profits, and often no viable business plan were seeing their stock prices double overnight. The herd was in a state of collective euphoria. Social proof was everywhere. Your neighbor was getting rich on some obscure tech stock. The news was filled with stories of 20-something millionaires. The pressure to join the party was immense. People abandoned all traditional metrics of valuation. They bought dot-com stocks not because they understood the business, but because the price was going up and they didn't want to miss out. This is a trading strategy based on pure emotion. The inevitable crash starting in the year 2000 wiped out trillions of dollars of wealth. Fortunes were destroyed. Investors who had bought near the top, driven by FOMO, saw their life savings evaporate. They learned the painful lesson that the crowd is often a stampeding herd heading for a cliff. Chasing momentum is an attempt to ride a wave of collective emotion. Being a contrarian is about understanding that those waves are your opportunity to buy the beach when no one else wants it. The direct financial connection of this contrarian mindset is the concept of time arbitrage. The professional investment world, driven by quarterly performance reviews and the constant need to show short-term results, is obsessed with the next 3 months. This structural short-termism is their weakness and your greatest strength as a retail investor. You have no clients to answer to. Your time horizon can be decades. Time arbitrage is the exploitation of this difference. When the market panics over a bad quarterly earnings report, it is selling a stock based on a 3-month data point. You, with your long-term perspective, can step in and buy that company based on its 10-year prospects. You are essentially taking the other side of Wall Street's impatience. This is how you can consistently achieve portfolio growth that beats the S&P 500. Let's look at the math. Imagine a great business whose stock falls from $100 to $50 during a market panic. The short-term trader who buys it at $50 and sells at $75 feels brilliant for making a 50% return. But the long-term investor who buys at $50 and holds for a decade, as the company's intrinsic value grows and the stock eventually reaches $300, has achieved a 6-fold return. The initial purchase at a panic-induced price dramatically lowers your entry point and acts as a massive amplifier for future compounding. Your patience and your ability to act when others are fearful are not just philosophical virtues, they are quantifiable financial assets. Mastering the psychology of the crowd is not about predicting the future, it's about capitalizing on the present, predictable, and profitable irrationality of others. This is the essence of a superior wealth management philosophy. We have established the need to identify wonderful businesses, the skill to recognize their temporary problems, and the temperament to act when the crowd is panicking. Now we must confront the dark side of this equation, the seductive allure of the opposite approach. This is the 4th pillar, and it is a crucial one, understanding the fallacy of the turnaround and deconstructing the seductive hope of corporate zombies. Buffett's maxim that turnarounds seldom turn is not just a catchy phrase. It is a scar earned through painful experience. Investing in a truly broken business is like trying to fix a sinking ship in the middle of a hurricane. It requires a perfect storm of luck, timing, and flawless execution. More often than not, one problem is solved only to reveal another, deeper one. The most poignant example from Buffett's own career, the one he calls his biggest mistake, was not a financial loss in absolute terms, but an error of such magnitude and opportunity cost that it still haunts him. It was his purchase of Dexter Shoe Company. In 1993, Berkshire Hathaway acquired Dexter Shoe for $433 million. On the surface, it looked like a classic Buffett business. It was an American-based shoe manufacturer with a strong brand, a history of profitability, and a reputation for quality. Buffett was so confident in the business that he paid for it not with cash, but with Berkshire Hathaway stock. This would prove to be a catastrophic decision. What Buffett failed to fully appreciate was that Dexter's economic moat, which had been built on its domestic manufacturing prowess, was rapidly eroding. Global trade was changing, and low-cost overseas competitors were beginning to flood the market with shoes of comparable quality at a fraction of the price. Dexter's competitive advantage was evaporating before his eyes. The business, which had been a picture of health, quickly started to bleed money. Despite enormous efforts to fix it, the company could not compete. Its cost structure was simply too high. The tide of global economics was an unstoppable force, and Dexter Shoe was caught in its path. Eventually, the business became worthless. The initial $433 million investment went to zero, but the true cost was far, far greater. Because Buffett had used Berkshire stock to make the purchase, the real cost was what that stock would be worth today. The shares he gave away are now worth billions upon billions of dollars. He had traded a piece of his compounding masterpiece, Berkshire Hathaway, for a dying enterprise. The lesson was burned into his soul. It is far better to pay a fair price for a business with a durable competitive advantage than to get a bargain on one whose advantage is disappearing. Dexter Shoe was the ultimate turnaround that never turned, and it serves as a permanent reminder that some businesses are simply too broken to fix. The psychological trap that lures investors into these situations is a powerful combination of the sunk cost fallacy and the narrative fallacy. The sunk cost fallacy is our irrational tendency to continue with an endeavor once we have invested time, money, or effort into it, even if the current evidence suggests we should stop. An investor buys a struggling stock at $20. It falls to $10. Instead of reevaluating their thesis and admitting a mistake, they think, "I've already lost so much, I have to hold on until it comes back." Worse, they might average down, throwing good money after bad, because their ego is now tied to being proven right. They become psychologically committed to the investment, and this commitment blinds them to the deteriorating reality of the business. This is compounded by the narrative fallacy. Turnaround stories are incredibly compelling. We love a comeback kid, an underdog story. A company on the brink of bankruptcy hires a charismatic new CEO who promises a bold new strategic direction. The press releases are filled with exciting buzzwords about innovation and restructuring. Investors fall in love with this story. The narrative of a glorious recovery is so much more appealing than the boring, ugly truth of the company's balance sheet, which shows declining revenues and mounting debt. They invest in the story, not the business. This hope-based investing is a recipe for disaster. It substitutes a compelling fiction for a sober analysis of the facts. To protect yourself from this trap, you need a mental model for diagnosing a dying business. Let's call it the corporate autopsy. It's a 4-point checklist for your stock analysis, designed to separate a true value trap from a viable investment. First, you must distinguish between industry headwinds and company missteps. Is the company struggling because of its own poor execution, or is the entire industry in a state of terminal decline? A company like General Motors in 2008 was suffering from both, but the brutal economics of the auto industry were a powerful headwind. A company in a dying industry, like a newspaper or a coal mining company, can have the best management in the world and still fail. As Buffett says, when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. Avoid businesses and industries with strong headwinds. Second, conduct a forensic analysis of the balance sheet. A healthy company's balance sheet is a thing of beauty. A dying company's balance sheet is a horror show. Look for the deadly combination of falling revenues and rising debt. This is the corporate death spiral. The company is borrowing money just to fund its day-to-day losses. It's a ticking time bomb. Pay close attention to cash flow. Is the company generating or burning cash? A business that consistently burns cash is not a business. It's a charity for its employees and suppliers, funded by its investors. Third, beware of the new CEO trap. Often, the narrative of a turnaround centers on the arrival of a messianic new leader who is supposed to single-handedly save the company. While great leadership is important, a new CEO is rarely enough to fix a fundamentally broken business model. If the only reason for hope is the hiring of a new executive, it's a massive red flag. It's an admission that the business itself has no inherent strengths. You are no longer investing in a business. You are gambling on a single person's ability to perform a miracle. Fourth, and most importantly, analyze customer behavior. Are customers leaving for a reason that can't be fixed? Are they abandoning your company for a competitor that offers a product or service that is demonstrably better, cheaper, or more convenient? This is the ultimate test. If a company has lost its relevance with its customers, no amount of financial engineering or restructuring can save it. Blockbuster's customers left for the greater convenience of Netflix. Sears, customers left for the better prices of Walmart and the wider selection of Amazon. These were not temporary defections. They were permanent shifts in consumer behavior. A business without loyal, paying customers is just a collection of assets waiting to be liquidated. Using this four-part autopsy, industry, balance sheet, CEO trap, and customers can save you from the immense financial and emotional pain of investing in corporate zombies. The antithesis, the hope-based investment strategy of the 99%, is a study in self-delusion. The investor caught in a turnaround trap exhibits a predictable pattern of behavior. They initially buy the stock because it looks cheap compared to its former highs. As it continues to fall, they don't question their premise. They double down, convincing themselves it's an even better bargain. They start to frequent online forums and social media groups dedicated to the stock, where they find a community of other bag holders. This creates a powerful echo chamber. Every piece of bad news is dismissed as short seller manipulation or fake news. Every vague, positive press release from the company is hailed as proof that the turnaround is just around the corner. They become obsessed with small, meaningless rallies in the stock price, what traders call a dead cat bounce, mistaking it for the beginning of a genuine recovery. They are no longer investors, they are cult members, clinging to a shared faith in the face of overwhelming negative evidence. Their portfolio becomes a museum of failed turnarounds, a testament to the destructive power of hope when it is untethered from reality. This is not how you achieve financial freedom. This is how you guarantee financial servitude, endlessly pouring your hard-earned capital into a black hole of failure. The direct financial connection here is one of the most powerful but least understood concepts in all of finance: opportunity cost. Every single dollar you have invested in a failing, stagnant, or dying business is a dollar that cannot be working for you in a thriving, growing, wonderful business. The cost of owning a corporate zombie is not just the money you might lose on that specific stock. It is the colossal gain you have forfeited by not owning something better. Let's make this tangible. Imagine it's the year 2000. You have $10,000 to invest. You can buy shares in Sears, a classic turnaround story. It's a massive American brand, but it's struggling. Or you can buy shares in a growing online retailer called Amazon. Over the next 20 years, that $10,000 in Sears will shrink to almost nothing as the company slowly bleeds out and goes bankrupt. That same $10,000 invested in Amazon would have grown to be worth millions. The difference between those two outcomes is the opportunity cost of betting on a turnaround. It is the difference between poverty and wealth, between a lifetime of financial struggle and achieving true financial freedom. The most important part of your asset allocation strategy is not just picking winners, but ruthlessly avoiding the losers. The surest way to underperform the market and sabotage your own portfolio growth is to fill it with the walking dead of the corporate world. Your capital is precious and finite. Do not waste it on hope. Deploy it in excellence. This leads us to our final and perhaps most challenging pillar. You've identified a wonderful business. You've waited patiently for a temporary problem to create a buying opportunity. You've acted with contrarian courage while the herd was panicking. You've avoided the trap of the corporate zombie. You've made the purchase. Now what? The answer is often the hardest thing for any active, intelligent person to do. Nothing. The fifth pillar is execution and patience, the unsexy but monumentally powerful secret to true compounding. In a world that glorifies action and trading, the greatest source of wealth creation often comes from disciplined inactivity. It's about letting your wonderful business do the heavy lifting for you over a very long period of time. There is no better illustration of this than Buffett's most famous and successful investment, Coca-Cola. In the aftermath of the stock market crash of 1987, the world was gripped by fear and uncertainty. At the same time, Coca-Cola was still recovering from its own self-inflicted wound, the disastrous New Coke marketing blunder of 1985. Although the company had quickly reversed course, the episode had shaken some investors' faith in the invincibility of the brand. Buffett, however, saw the situation with perfect clarity. The crash was an external problem. The New Coke fiasco was an internal but ultimately superficial problem. In fact, the public outcry had only served to reinforce how deeply people loved the original formula. He saw a business with one of the most powerful brands in human history, a global distribution network that was virtually impossible to replicate, and a simple, profitable product. And thanks to the market malaise, it was being offered at a reasonable price. Starting in 1988, Buffett began to buy Coca-Cola stock, and he didn't stop until Berkshire Hathaway had invested over $1 billion, owning nearly 7% of the company. It was a massive, concentrated bet. And then, he did the most important thing of all. He held it, and held it, and held it. He didn't sell after it went up 50%. He didn't trade around his position. He didn't get bored and look for the next exciting thing. He simply sat back and allowed the power of the Coca-Cola business to work its magic. Year after year, the company sold more beverages, expanded into new markets, raised its prices, and gushed cash. It bought back its own stock and relentlessly increased its dividend. That $1 billion investment has since paid Berkshire many billions in dividends alone, and the stock position itself has grown to be worth well over $20 billion. This colossal creation of wealth was not the result of a brilliant trading strategy. It was the result of one brilliant decision followed by 3 decades of extraordinary patience. Buffett understood that once you own a piece of a truly great compounding machine, the best thing you can do is get out of the way. The psychological principle that makes this so difficult is called action bias. Our brains are wired to believe that taking action is superior to inaction. When faced with a problem, we feel a powerful urge to do something. In the context of investing, this manifests as a constant desire to tinker with our portfolio. We check our stocks multiple times a day. We read an article and feel the need to sell one stock and buy another. We see the market go down and feel we must act to protect ourselves. This bias is relentlessly stoked by the financial media, which profits from activity. Don't just sit there, do something, is their implicit message. This constant churn feels productive, but it is the enemy of long-term portfolio growth. Every transaction incurs costs, both direct, commissions, and indirect taxes. More importantly, it interrupts the single most powerful force in finance, the magic of compounding. Buffett's true operational genius is his cultivated capacity for inactivity. He has a stack of business reports on his desk, and his phone rarely rings. He spends most of his day just sitting and reading and thinking. He understands that in investing, your results are not determined by the frequency of your actions, but by the quality and wisdom of the few actions you do take. Overcoming action bias requires a fundamental shift in mindset, from seeing yourself as a trader to seeing yourself as a business owner. A business owner doesn't sell their successful private company just because they had a good year. They they hold on to it and let it grow. That is the mindset required for superior returns. To cultivate this patience, you need a practical mental model for post-purchase behavior. Let's call it the gardener's mindset. A great investor behaves like a skilled gardener. First, the gardener knows to water the flowers and pull the weeds. In portfolio terms, this means you should resist the urge to average down on your losing positions, the weeds. A falling stock price is often a signal that your initial thesis was wrong. Throwing more money at it is a classic sunk cost fallacy. Instead, consider adding to your winning positions when they experience temporary pullbacks, watering the flowers. Your best ideas are often the ones that have already proven themselves to be correct. Second, the gardener has a patient, long-term perspective. They don't dig up the seeds every day to see if they are growing. They trust the process. As an investor, this means you must adopt the discipline of the annual review, not the daily ticker. Set aside time once a year, after the company has released its annual report, to rigorously reevaluate your original thesis. Has the company's moat widened or narrowed? Is management still allocating capital intelligently? Is the business still performing as you expected? This disciplined, infrequent review process keeps you focused on the long-term business results, not the short-term market noise. Third, and most crucially, the gardener knows the specific conditions under which they will harvest. You must define your selling conditions in advance when you are in a calm and rational state. There are only 3 legitimate reasons to sell a wonderful business. 1. Your original thesis is proven wrong and the business fundamentals have permanently deteriorated. 2. You have found a demonstrably better investment opportunity that offers a much higher expected return and you need the capital. 3. The stock price has become so absurdly overvalued that its future expected returns are negligible or even negative. Notice what is not on this list. Because the stock went up 20% to lock in profits, or because the market is crashing. Selling for these emotional reasons is the primary way investors cut their flowers and water their weeds, guaranteeing a portfolio of mediocrity. The gardener's mindset transforms you from a hyperactive gambler into a patient cultivator of wealth. The antithesis of this mindset is the path of the 99%, the hyperactive trader. This individual is addicted to the action. They may even be skilled enough to buy a great company at a fair price, but their impatience is their undoing. The stock goes up 25%, and the urge to ring the cash register and lock in the gain becomes irresistible. So they sell. They feel smart for a moment, but then they watch in agony as that same stock goes on to double, triple, and eventually become a 10-bagger over the next decade. They have sold their winning lottery ticket for a pittance. They then take their small profit and look for the next play. They are constantly churning their portfolio, jumping from one idea to the next, never allowing any of their investments to mature and compound into real wealth. Their brokerage statement shows a flurry of activity, but their net worth stagnates. They are running faster and faster on a financial treadmill, racking up transaction costs and paying unnecessary taxes, all while going nowhere. They have mastered the art of snatching defeat from the jaws of victory because they have never learned the simple, profound power of sitting still. The direct financial connection here is a twofold engine of wealth destruction: taxes and interrupted compounding. Let's run the numbers. Investor A buys $10,000 of a wonderful business that compounds at 15% per year. He holds it for 30 years. At the end, his investment is worth over $660,000. He pays long-term capital gains tax just once, at the very end. Now consider investor B. She buys the same stock, but she is a hyperactive trader. She sells every time the stock is up 50% and then buys it back, trying to time the market. Let's assume she is a genius and manages to capture the exact same 15% gross annual return. However, every time she sells, she has to pay short-term capital gains tax on her profit. That tax friction acts as a constant drag on her returns. The money paid to the government each year is money that is no longer in her account to compound. After 30 years of the same gross return, her final net worth will be significantly, perhaps hundreds of thousands of dollars less than investor A's. This tax inefficiency is a massive self-inflicted wound, but even more powerful is the interruption of the compounding process. The smooth, upward-sloping curve of compounding is a thing of beauty. By constantly trading, you are resetting that curve back to the beginning, over and over again. You never allow your capital to reach the steep, explosive part of the curve where true wealth is created. Patience is not just a virtue. It is a mathematical necessity for anyone serious about achieving financial freedom. Your ability to buy right and then sit tight is the ultimate and most often ignored key to building a portfolio that will not just support you, but will grow for generations to come. You have just been given a powerful piece of a larger machine. You've journeyed through the core philosophy that transformed a young man from Omaha into a legend, a mental model that filters the noise of the market into a clear signal of opportunity. You now understand that the pursuit of corporate zombies, the seductive hunt for the turnaround, is a loser's game. You've learned to see beyond price and identify the DNA of a truly wonderful business. You have a framework for distinguishing a temporary, solvable problem from a terminal decline. You know that the market's fear is not a threat, but a gift, an opportunity to buy excellence at a discount. And you grasp that once you have made your move, your greatest ally is not activity, but the patient, relentless force of time and compounding. This is more than just an investment strategy. It is a complete operating system for rational decision-making in a world of chaos. But you must understand that what you've mastered today is one critical gear in a much more complex and interconnected system. Warren Buffett's mind is not a collection of isolated tricks. It's a latticework of mental models, each one supporting and strengthening the others. The ability to identify great businesses facing temporary problems is powerful, but it's made exponentially more effective when combined with the principles of calculating intrinsic value, understanding the circle of competence, or knowing when to make a concentrated bet. Each model is a piece of a map, and having one piece is infinitely better than having none, but it is not the same as holding the entire map in your hands. You've built a powerful foundation, but the skyscraper of your financial future is not yet complete. The video that is now appearing on your screen is not an accident. The algorithm has analyzed your commitment to this deep dive, and it has identified the next logical step in your journey. Think of what you've learned today as a key. That next video is the lock it was designed to open. It is the missing link, the piece of the map that connects the territory you've just conquered to the vast, profitable landscape that still lies ahead. It holds the next mental model you need to add to your arsenal, the one that will synergize with today's lesson and amplify its power. The choice you face right now is not merely about watching another video. It is a decision about who you want to become. Do you want to remain a tourist in the world of serious investing, collecting random tips and tricks? Or are you ready to continue the ascent, to continue forging the intellectual armor required to build lasting wealth? The path to becoming a truly sophisticated investor, a capital allocator with a CEO mindset, is a journey of continuous learning. That next click is not a passive act of consumption. It is an active step toward completing your mental toolkit. It is your commitment to finishing the map. The next piece of the puzzle awaits. Continue your ascent.